think it says on my screen the recording is paused, but that's probably Zoom's recording.
It's live.
Welcome to the Labor and Workforce Continuing Education Series. My name is Matt Piesold, and I'm a Labor and Workforce Specialist located in Kansas City, Missouri. This webinar series represents an outgrowth of past collaborations between MU Extension, Labor and Workforce Development, and the Department of Labor. It is an honor to welcome Kathy Robinson, JD, from the Department of Labor. Over the next 2 weeks, we will offer a series of webinars that will prepare your business, agency, and organization for its legal obligations and responsibilities, and we will connect you to the resources and experts that can help you navigate these complex employment obligations. We ask you to please post your questions in the chat feature or save your questions until the end of the presentation. At this point, I'd like to turn it over to Kathy. Kathy?
Good morning. My name is Kathy Robinson, and I'm a benefits advisor with the U.S. Department of Labor with the Employee Benefit Security Administration, and I've been there about 11 years. I've been an attorney and a mediator for over 25 years. And part of my job as a benefits advisor is to do outreach presentations such as this. If you listened to the presentation yesterday, there will be some overlap, and I've added information with regards to group health plans since yesterday's was retirement plans. But hopefully it will be novel and new, helpful information for everyone else who is attending today. And I'm hoping that you might also attend the webinars that we have set up on the 17th for what to expect from an EBSA investigation or audit, and on the 24th, which is more information about voluntary fiduciary correction programs. So the benefits advisors do two important functions. One is we answer toll-free lines for the public, plan administrators, plan sponsors, fiduciaries, third-party administrators, other service providers, Monday through Friday, 8 to 4:15 Central Time. And the number for that is 866-444-3272. And the other crucial important component of our job is that we provide outreach presentations such as this to help people have the knowledge necessary about what to do to remain in compliance with ERISA, which is the Employee Retirement Income Security Act, which is the law that our agency has jurisdiction over, which applies to private employer-sponsored or union-sponsored employee benefit plans subject to ERISA, such as group health plans and retirement plans like we'll be talking about today. If you've heard me speak before, you've heard me say that by far my favorite part of my job is to provide these outreach presentations. And if you are affiliated with a nonprofit and would like to contact me to set up a presentation on any of a number of topics that we have available, feel free to contact me. My personal work number direct to me is 816-285-1874. So it's a pleasure to be here with you today to talk about fiduciary duties for group health and retirement plans. I always like to say a little bit about what I take into consideration regarding the audience as I'm preparing for them. I would imagine that you probably are fairly well versed in employee benefit plans such as group health plans and retirement plans, and probably work either with group health or retirement plans on a regular basis, perhaps both on a regular basis. Just for completeness and clarity purposes, there are a couple slides where I do cover some basics like, what is a group health plan covered by ERISA? And what is a summary plan description? But for the most part, I think for people who work normally in the field, there might be some clarifying information and perhaps new information that you didn't already know. And hopefully some of the information you're already familiar with, and it just kind of reinforces what you already know. Today's presentation is more than we can actually cover in an hour. I will try to leave at least a few minutes for questions and answers at the end, and we'll stay as long as necessary to answer all questions. But I've included some slides on topics just for completeness purposes, but I don't intend to actually go over those slides. And that would be those that are related to fee and investment expenses, disclosures, slides 44 through 48. Those with regards to prohibited transactions, slides 55 through 90. And with regard to prohibited transactions, my thought process there is that it certainly is important, but it's complicated enough that really it deserves its own topic. And a little bit of information can be dangerous. And so when that's covered, it needs to be covered thoroughly so that people are fully informed and don't get the wrong impression. For instance, there are transactions that are prohibited unless they're not, because there's an exception that is met or something like that. Also, under reporting requirements regarding the 5500s, we're going to skip over those slides, which are 93 through 104. Also, the ones regarding fidelity bonding, 120 through 124, and the specifics regarding the VFCP program, 125 through 143. But we will do the slide at the end beyond that. And like I said, we do have a fiduciary, voluntary fiduciary correction program presentation coming up on September 24th, and you certainly are welcome and encouraged to attend that. So let's go ahead and get started. Basically, this publication, Getting It Right, Know Your Fiduciary Responsibilities, is on our website, and I recommend that you have a copy of that. You could even call me and have one mailed to you. I'm rarely actually at the office. You might hear the train in the background as I am teleworking, but we do occasionally go to the office, and I can do that to mail something out. And then this next slide is a list of, is basically examples of publications that I recommend that you either read on the website or perhaps obtain a copy of, either by printing it out or asking me for a copy if you want, or calling the toll-free line. There's also some ones with regards to group health plans that you might find helpful. So what we're going to go over today are the basic rules of fiduciary duties under ERISA. Getting it right by avoiding common problems, a tad bit to make you aware that there is such a thing as voluntary fiduciary correction programs, and I'll cover that very briefly, and then giving you contact information about where to go, how to access our website, how to submit a web inquiry, etc. at the end, along with an opportunity for questions and answers. Excuse me. I do request that you hold your questions and answers till the end so that I can adequately manage. We still have the 144 slides minus the ones that I've said I won't go over. So getting it right means understanding your plan and your responsibilities. And this depends on what your position is. At a minimum, you need to understand your responsibilities individually as they relate to the plan or plans that you work on, and be familiar with at least the summary plan description and probably the underlying plan document that the summary plan description is based on. But if you, and that would be for every plan that you work with. I also recommend, if you're a participant in any of those plans, such as the group health plan or the pension plan or the 401k or what have you, that as a participant, you make it a habit that you read the summary plan description and every year when there are changes. Typically, not always, but typically there are changes to the summary plan description when each plan year changes for the group health plan. And sometimes there are significant changes. You can't just assume, since it's the same carrier and the same plan, that the plan hasn't made changes. 2, it's important to carefully select service providers, and we'll go over that more extensively. 3, make timely contributions, and what that means. It doesn't necessarily mean what a lot of people assume that means based on their reading of ERISA. And so I clarify what it actually means to make sure everyone's on the same page about that. 4, avoid prohibited transactions. Like I said, that's its own presentation, but I did include slides on that for completeness purposes. And then the importance of making timely reports to the government and disclosures to the participants. And I did say that I'm not going to go over the 5500s in detail. That also could be its own presentation. But what I will say is, if you don't file the report, the 5500, with the Department of Labor timely, and a lot of them also have to be filed with the IRS, there are fines that are imposed. And they can be quite expensive. I remember when I started working for the Department of Labor, I was surprised at just how expensive it is to file that late. But we also have something called a delinquent filer program that's available. One thing that I'll say, well, I'll say it later. With regard to the VFC program, when we get there, I'll say the other thing I was going to say. Okay, and then also disclosures to participants, which we'll talk about a little more in depth. We're going to talk about some of the disclosures that are required with regards to group health plans and retirement plans. It's not an exhaustive list, but we do have publications that do have exhaustive lists of what disclosures are required. And so I recommend that you either look on our website to find those, or you can call me and I'd be happy to provide those to you, or you can call the toll-free line and whoever you talk to can mail those to you. So our agency, Employee Benefit Security Administration with the Department of Labor, has jurisdiction over ERISA, which I've said, but also we share jurisdiction with the IRS, and plans are also subject to the Internal Revenue Code. What we have jurisdiction under ERISA are the reporting, such as the 5500s, the disclosure requirements to participants and beneficiaries, fiduciary responsibilities, which is what we're going to spend the vast majority of our time talking about, but also includes the other issues that are covered under ERISA. We're not going to talk about prohibited transactions, but I've included information. And then also benefit claims procedures a little bit with regards to pensions, and a little bit more in depth with regards to group health plans. And the way that the Internal Revenue Code comes into play, as you may already know, is tax qualification rules. So for instance, if a participant puts a contribution out of their paycheck into their 401k, that typically, unless it's a Roth, that typically would be a pre-tax deferral. But there are tax qualification rules, as you probably know, in order for those contributions to be considered pre-tax. The plan has to qualify under the IRS code. Important elements of a plan which must be there. All ERISA plans must be maintained pursuant to written instruments. There was a gentleman who attended a previous presentation that I did who was telling me, I believe he's a broker, and had talked to Amy also, and he was having a hard time convincing his clients that they needed their 401k plans and group health plans to be maintained pursuant to written instruments. And I honestly can't imagine how you could not have a written instrument for a group health plan or a pension plan that describes the benefit structure and operation of the plan. Otherwise, how would people know if there's an employer match, or under what circumstances, or what percentage they can allocate, or what kind of plan it is and how it works, and how to access benefits and when or when not to, and their rights under the plan. Or what's covered under a group health plan, what's covered and what's not covered. I think an employer.
Personally, did you not bring me anything to eat?
So if everyone could make sure that their computers are muted, that would be really helpful. ERISA also requires that the written instruments provide for one or more named fiduciaries responsible for the operation and administration of the plan. And basically, this isn't someone's name. This would typically be a function or a title, and it could be several people. Those who have fiduciary responsibility, what's the overview that I'm providing for fiduciary responsibilities? We're going to talk about what and who is a fiduciary. What are the primary duties of a fiduciary? Are there any limits on the fiduciary duties? And if so, what are they? What can happen if one does not live up to their fiduciary duty responsibilities? And how to avoid problems by remaining compliant and doing the right thing to avoid getting yourself in trouble. So let's start with what is a fiduciary. One thing of note here is that this is a functional definition. Few positions, by virtue of the fact of their position, although there are some, automatically make someone a fiduciary. It's a functional definition. If you meet if you do something that falls under the definition, then essentially you're a fiduciary. So basically, it's a position of trust acting for the benefit of others with a high duty of care and loyalty. And it's one of the highest duties under the law that someone can have and be held to. With ERISA, the definition of a fiduciary is any person who exercises discretionary authority or control over plan assets or administration, or gives investment advice for a fee. So obviously, it's pretty easy to tell if someone gives investment advice for a fee. The one that you have to think through is any person who exercises discretionary authority or control over plan assets or administration. This would not mean just a clerical position because if they are just told, do this or do this, and they don't have any discretion, they don't have authority or control over plan assets that's discretionary or administration, then that would not be someone who rises to the level of a fiduciary. But one thing to keep in mind is that someone who's not a fiduciary now, if their job changes or if their responsibility changes, or by either adding jobs or combining jobs or adding responsibilities that rise to the level to where they're now exercising discretionary authority or control over plan assets or administration, you can become a fiduciary. And so it's important to keep track of thinking of the definition and determining whether or not you're a fiduciary, because if you're a fiduciary, you could be subject to liability. And I apologize, it looks like this next slide, there's a little bit of a thing that's hard to read. So what is an ERISA group health plan? It's an employment-based plan that provides coverage for medical care, for instance, hospitalization, sickness, prescription drugs, vision, dental. It's what we would consider to be a major medical plan and not a limited benefits plan. The plan can provide benefits through insurance or be what we call self-insured. When we say through insurance, we call that fully insured. Meaning that the employer, which may or may not include employee contributions towards the premiums, the employer pays the premiums to a carrier, and the carrier assumes responsibilities to pay the claims out of their funds. Or rather than being fully insured, the plan might be self-insured. Basically, the benefits are paid from the employer's assets or a separate trust set up and funded by the employer. Now, it can be tricky sometimes to tell if someone is self-insured because very often it's a self-insured plan, but the employer has hired an insurance carrier like Blue Cross and Blue Shield or Cigna or what have you to be the third-party administrator to determine the claims and physically pay the claims, even if they're not assuming responsibility to come up with the money as the carrier for the claims. So just because Cigna or Blue Cross and Blue Shield or Aetna or whomever is involved doesn't mean it's fully insured. You can't just assume that. And one of the key distinctions between whether or not a group health plan is self-insured or fully insured is that plans that are fully insured are subject to state law and federal law. And of course, federal law would be ERISA, which is what we have jurisdiction over. But self-insured plans are only subject to federal law, not state law. Claims procedures for group health plans. We have a regulation that's there on the slide. It includes timeframes for deciding claims, the required contents of notices of denials, the standards that must be met for appeal purposes. And then with regards to the fiduciary, the plan administrator would be a fiduciary, a trustee would be a fiduciary, a plan sponsor would be a fiduciary, an investment manager would be a fiduciary. A plan attorney or accountant may or may not be a fiduciary, depending on whether or not they meet the functional definition. The insurance company would likely be a fiduciary. So what is a claim for benefits as it speaks to group health plans? It's a request for a plan benefit made in accordance with the plan's reasonable filing procedures by the participant or beneficiary or an authorized representative on his or her behalf. There are time limits for deciding group health claims. If it's urgent care, such as life or death, or significant harm to the patient if they don't receive care within 72 hours, then the claim must be determined by the plan administrator or the insurance carrier within 72 hours of receipt. If they are trying to get a pre-approval or a pre-authorization, then there are 30 days to determine that claim, and then they can get a 15-day extension, and sometimes two 15-day extensions depending on the circumstances. And then if it's after the claim is incurred, which we call post-service, they have 60 days to adjudicate and determine the claim, and it's possible to get a 30-day extension of that. If a claim is denied, the notice of that denial has to contain specific information: the reason for the denial, which plan provisions are implicated and used towards making the decision for the denial, disclosure in the denial of the protocols at play in the situation, an explanation of scientific judgment, their 502A rights, material needed to perfect the claim, and review procedures. And what we mean by review procedures is basically information about their ability to appeal. Appeals procedures for group health plans. After they receive an adverse benefit determination is what we call it, but basically a denial, they have 180 days from the date of the denial, essentially, to file an appeal. In that, there should be an identification of medical experts. The plan cannot require more than 2 appeals, and there are limits on a plan's requirement that claims be submitted for arbitration. The appeal denial notice contents are similar: the reason, the plan provisions implicated, the disclosure of protocols involved, explanation of scientific judgment, 502A rights, voluntary appeal procedures, and the right to relevant documents related to their claim and the denial of their claim. Other basic fiduciary duties: to act solely in the interest of the participants and their beneficiaries, to be prudent, to pay only reasonable and necessary expenses of the plan, and to follow the terms of the plan, which is why it's important to know what the terms of the plan are. Acting solely in the interest of the participants and beneficiaries means the decisions are made exclusively on the basis of what is good for the plan and its participants and beneficiaries. Not what's good for the person who's making the decision, not what's good for the business, but for the plan and the participants and beneficiaries. Prudence is a process. Make sure you keep records and documentation of the decision making, the decision you made, and what you used to make that decision to justify why your decision is prudent. Because a fiduciary must act with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters, in other words, people who know what they're doing, would use. So if you need to hire help or otherwise get help, get it to make sure that you meet your fiduciary duties. Reasonable expenses are those that are only necessary for the operation of the plan and not excessive for the services received. Make sure you're not duplicating payment. Don't pay someone to do something in-house that you're paying a third-party record keeper to do. Or perhaps better said, don't pay a third-party record keeper to do something that someone in-house is also doing or is already doing. Following the terms of the plan means don't exercise personal discretion when terms of the plan is clear. You need to follow what the plan says, what the plan rules are. Limits on fiduciary liability. If the plan allows it, fiduciaries can allocate responsibilities. And some cases, they're still on the hook for liability, and in some cases, they're not. And it's also important to know that not all acts relating to a plan are fiduciary acts. It's those that involve either providing investment management for a fee or discretionary authority over control. Discretionary authority or control over plan assets or administration. You can allocate duties to other fiduciaries if the plan permits. In that case, you're not necessarily liable for the acts or omissions of other fiduciaries. If you do appoint an investment manager for monies, you're not liable for the acts or omissions of the investment manager, but you do have a duty to monitor other fiduciaries and the investment manager. If it's a participant-directed pension plan account, a defined contribution plan, fiduciaries of individual account plans are not liable for the investment decisions of the participants if the participants are the ones essentially making the investment decisions over the options available to them under the plan. But it must meet the requirements of the Department of Labor regulation, and you're still liable for the investment options that are provided to the participants. Selection of a qualified default investment alternative is a fiduciary act. And basically what this is if a participant doesn't want to or just doesn't make a choice, even though they have the option to choose where their money is invested among the options provided by a pension plan, but they choose not to, you have a default alternative where their money would automatically be allocated should they not choose otherwise. But fiduciaries of 401k type plans may limit their liability for investing contributions on behalf of participants when they fail to provide investment directions other than the QDIA, or which causes them to be in the QDIA. Must meet the requirements of the QDIA regulation, and examples include balance funds and target date funds. Missing participants. Say you are administering the plan and maybe mail is returned when you're sending out required disclosures or anything else, or you're terminating the plan perhaps and you're trying to locate people to pay them out. We do have a field assistance bulletin that's listed there, and there are requirements that are pretty extensive that plans must engage in to locate missing participants. The fiduciary must always use certified mail, check related plan and employer records to see if there are alternative addresses or phone numbers or beneficiary information where they could get up-to-date information for the participant or the beneficiary, and use free electronic internet search tools. When you're making distributions and have missing participants, options, if you can't find people, you can use PBGC's, which is the Pension Benefit Guarantee Corporation's Missing Participants Defined Contribution Plan program. You can roll the money over to an IRA. There's a safe harbor for distributions from terminated individual account plans, and information about that is noted on the slide. Also, you could put the money in an interest-bearing federally insured bank account or send it to the state unclaimed property fund. But that's only after you've diligently fulfilled the obligations of what you're supposed to do to locate a missing participant as outlined in the field assistance bulletin that I mentioned. So what if a fiduciary fails to fulfill his or her obligations as a fiduciary? They may have to restore losses to the plan. They may have to give up any profits. The DOL or IRS and IRS may assess civil penalties and excise taxes. The fiduciary may be removed as fiduciary and possibly barred from being a fiduciary in the future. There can also be co-fiduciary liability, where a fiduciary will be liable for another fiduciary's violation if the fiduciary either participates in or acts to conceal a violation, or permits another fiduciary to commit a violation, or has knowledge of another fiduciary's violation and fails to take reasonable steps to remedy the situation. Okay, getting it right. Avoiding problems, maintaining compliance with the law. Most of the time, a basic understanding of fiduciary responsibility and using common sense will keep plan sponsors and fiduciaries in compliance with the law. Also, problems can be very expensive to correct and result in bad employee and public relations. What you can do to avoid common problems. And I like to say this is, I think, the most important slide in the entire presentation. 1, understand the plan and responsibilities, carefully select service providers, make timely contributions, avoid prohibited transactions, make timely reports to the government and disclosures to the participants. And that was on an earlier slide, but I think it's important enough that it bears repeating. Understand your plan and your responsibilities. Know who is responsible for the various activities required of the plan. Who has custody of the plan assets? Who does the record keeping? Is some of it in-house? Is some of it with a third-party administrator? Excuse me. Or a separate record keeper? Who's making the benefit decisions? Who's directing the investments? Delegations. When assigning responsibility of duties, whether to something like an internal committee, human resources department, or specific human resources personnel, or an external service provider such as a third-party administrator, make sure they understand their responsibilities. Make sure they have the knowledge and information necessary to carry out their responsibilities, and monitor to make sure they carry out their assignments. That this is crucial. It's also crucial that at least one person at the company know who is on code or and what's that? Well, otherwise, I will just,